The Silicon Valley Bank collapsed. It had no head of risk assessment for 9 months before it collapsed. Silicon Bank operated without a chief risk officer between April of 2022 and January of 2023, while the operations United Kingdom-based head of risk stands accused of prioritizing pro-diversity initiatives over her actual role. So again, because they're so focused on this ESG political agenda, they're not paying attention to the basic role that a bank is supposed to be playing. They're not doing their normal job. The real cause of everything we're watching right now, which is actually fractional reserve banking. And so this is causing what we're seeing now, which is runs on the bank. People want to get their money out of the bank while the money is still there. Because again, because of fractional reserve banking, the banks only keep so much of your money. The rest is elsewhere, and seems now they put it in bad investments because, again, because of environmental social governance, they're not necessarily investing in things that are going to get you back your money. A lot of it is like, again, investing in things that are not financially sound. What's happening currently, because I know there's a lot of noise right now, and it's probably hard for people to make sense of what's going on. But David Sachs says this. He said, the Fed may or may not realize, but it has created a two-tier banking system. Tier 1. Systemically important banks. These are the too big to fail biggest banks. If you have money there, it's a true deposit and you cannot lose it. And tier 2 is everybody else. If you have money there, it's not a true deposit. It's an unsecured loan to that bank, and you can lose it in a bank failure. Now tell me, why would you use tier 2? Just like I said earlier in this episode, hypothetically speaking, imagine they have this new insurance system. You have some banks that are in it and some banks that are not. Why would you keep your money in the banks that are not in it? Everybody who wants to make sure their money is secure is going to take their money out of these banks, not part of this newly announced system, and they're going to put it in the one that is. And you could see, unless these banks rapidly get on this system through the Federal Reserve and the Treasury as soon as possible, you're going to watch those banks deal with potential runs in the bank, frankly, because people are going to want to make sure their money's insured. And then there's a bigger issue that banks basically can operate now with far less consequences. Remember, this was part of the problem that started it all, right? One of the many problems, again, brought about by the Federal Reserve, I should note as well. And I should note as well that people are also pointing to part of the problem with this, which is environmental social governance. Basically, the fact that banks are not making smart investments. Again, normally there are problems inherent within fractional reserve banking in general. And again, because you have these kind of fundamental problems within it where they're taking, basically they're making a bet all the time. They're taking some of your money and they're investing it, and you could argue that that's good because, it basically it helps the economy and whatever else. The problem is if, for example, they make bad investments and lose all the money, or they make bad investments and, basically people want their money back and there's a run of the bank and they don't have money to give back to people, right? There are inherent problems within fractional reserve banking, again, only brought about, I would say, mainly by the Federal Reserve, because they can make much more risky investments because of the bailout system through inflation. But what this does now is incentivizes investments that are less lucrative, basically. And this is what you are starting to see with ESG. This is not investments being made to make money. This is not investments being made that are going to necessarily be profitable. This is investments being made that are about politics and, global warming, or climate change, or whatever they want to call it, or racism, and things that basically support a really left-wing political agenda that don't necessarily make money and might even lose money. SVB is being called out on this because SVB, the first bank to really have some really serious issues with what we're watching right now, again, the Silicon Valley Bank, this is what they were doing. This is Daily Mail. It says SVB had no head of risk assessment for 9 months before it collapsed. And that was as its woke boss for Europe, Middle East, and Africa was busy organizing a month-long pride campaign and a lesbian visibility day. So if you're wondering what the head of the company was doing, they were working on gay rights stuff and lesbian visibility. It says this: collapsed lender Silicon Bank operated without a chief risk officer between April of 2022 and January of 2023, while the operations United Kingdom-based head of risk stands accused of prioritizing pro-diversity initiatives over her actual role. So again, because they're so focused on this ESG political agenda, they're not paying attention to the basic role that a bank is supposed to be playing. They're not doing their normal job. It says SVB's former head of risk, Laura Izurieta, who formerly performed a similar role for Capital One, left the bank in April of 2022. She wasn't replaced until January of 2023, when the bank hired Kim Olsen, formerly of Japanese bank Sumitomo Mitsui. Meanwhile, Jay Erespa, who acts as CRO for the Bank of Europe, that's Risk, Africa and Middle East, and who describes herself as a queer person of color from a working class background, organized a host of LGBTQ initiatives, that's all the gay stuff, including a month-long pride campaign, and implemented safe space and catch-ups for staff. In a corporate video published just 9 months ago, she said she could not be prouder to work for SVB, serving underrepresented entrepreneurs. They were focused on this ESG woke policy stuff, in other words. It says further in, Professional Network Outstanding listed Eraspa as a top 100 LGBT future leader. It says Jay is a leading figure of the bank's awareness activities, including being a panelist at the SVB's Global Pride, that's the gay stuff, town hall, to share her experiences as a lesbian of color, moderating SVB's EMEA Pride Town Hall, and was instrumental in initiating the organization's first ever global safe space catch-up, supporting employees in their experiences of coming out. Becoming openly gay, I guess. Her bio of the outstanding website states, as well, it adds that she is allies with gay rights charities Stonewall, and had authored numerous articles to promote LGBTQ awareness. These included Lesbian Visibility Day and Trans Awareness Week. And so, in other words, as they were running into all these issues and as they were heading towards this, the freight train hitting a dirt road, as one of my old school teachers used to put it, as the freight train was nearing the dirt road, right? Rather than try to avert that disaster, rather than try to fix the problem, she was engaged in, gay rights stuff and, this woke policies and so on. Again, ESG, environmental social governance, and just looks like, political activism, basically, while the company was running into all these problems. This is the Mises Institute. I am a personal fan of, Austrian economics, personally. I believe Austrian economics tends to be very reasonable and also is one of the strongest arguments, interestingly, at least on the economic side, against communism and socialism. But let me show you this. This is from the Mises Institute. And it says the faults of fractional reserve banking. It says, now let us turn to fractional reserve banking. It means that a bank lends out money that clients have deposited with it. Fractional reserve banking thus leads to a situation in which two individuals are made owners of the same thing. In other words, it's your money, you own your money, but the bank is also basically using your money as if the bank owned your money. Who owns it? They say it's essentially the case where two people are made owners of the same thing. Fractional reserve banking thus creates a legal impossibility. Through bank lending, the borrower and the depositor become owners of the same money. Fractional reserve banking leads to contractual obligations that cannot be fulfilled from the outset, as we're seeing now. That's the problem with runs in the bank. There is a contractual obligation that cannot be fulfilled. The bank has your money. It's your money. You go to the bank to get your money. The bank won't give you your money because the bank spent your money, because the bank is treating your money as if it owns your money. Keep in mind, some banks do charge you to have your deposits there. You're paying them to hold on to your money, right? But again, because of fractional reserve banking, they can use your money as they're claiming to hold it, creating, again, this contractual issue of whose money is it. It says, as Hopp, Block, and Holzman noted, any contractual agreement that involves presenting two different individuals as simultaneous owners of the same thing, or alternatively the same thing as simultaneously owned by more than one person, is objectively false and thus fraudulent. A, quote, fractional reserve banking agreement, they say, implies no lesser an impossibility and fraud than the involved in the trade of flying elephants or squared circles. They're saying this is basically fraud under the disguise of a legitimate business practice. The truth is that fractional reserve banking amounts to violating the nature of the law of property rights. Further, it states, the reason that fractional reserve banking has been around for quite some time is due to government law, which of course must be distinguished from the natural law of property rights. Of course, governments can make fractional reserve banking legal in a formal sense. However, even government law does not change the nature of things. As Murray and Rothbard put it succinctly, great writer, by the way, fractional reserve banking creates money out of thin air. Essentially, they do it in the same way as counterfeiters. And I would argue this is very much basically a counterfeit. Counterfeit and fraud, in my opinion. And I would agree with Murray and Rothbard. Essentially, they do it in the same way as counterfeiters. Counterfeiters, too, create money out of thin air by printing something, masquerading as money, or as a warehouse receipt for money. That's the way counterfeiting works. And the banks do the same thing. They just don't call it a crime is all. At least they don't call it a crime. And Murray and Rothbard said, in this way, they fraudulently extract resources from the public, from the people who have genuinely earned their money. In the same way, fractional reserve banks counterfeit warehouse receipts for money, which then circulate as equivalent to money among the public. There is one exception to the equivalence. The law fails to treat the receipts as counterfeits. He's arguing the only difference between fractional reserve banking and counterfeiting is that fractional reserve banking is considered to be legal, wherein in reality it's counterfeiting. And you could argue that they're counterfeiting while, claiming to increase the value of an investment, but you don't get the value of that. The bank does. The bank is using your money.